He has dealt with various subjects of bank audits, accounting standards, standards on auditing, auditing of insurance company, network and borders of CA. He has been a trainer of EIRS, course of ICAI, and certified course on concurrent audits of banks of ICAI, various centers across the country. He has also contributed tremendously towards writing various articles in various publications related to bank audits issued by Institute and WIRC. I would like Mr. Purushottam Khandelwal, RCR, to present bouquet and memento to our faculty.
Good morning, friends. At the outset, my sincere thanks to Chintan and Steve for giving me this opportunity to come here and share my views on verification of advances in a bank branch audit. One more thing which we should compliment them is that they have kept this conference for 2 days. So because what happens is, I've been talking on this topic, never it is only advances. Something has to be developed because in one day you have to wrap up everything. So, both of them, thanks for keeping it 2 days so that at least we can have some interesting discussions. Coming to verification of advances, what I am trying to cover is what has been given as a scope to me. So, I will start with how one should select the sample, what could be the possible checklist one can use during this 4 or 5 days affair bank branch statutory audit, and what are the governing factors which would impact on my verification of audit, verification of advances, what the other reports which we receive in respect of certain advances which will have an impact on my testing, and some practical case studies and when we'll talk about certain issues in verification of advances. Friends, you all know this bank audit exercise is an annual ritual, and every year in the month of February and March we start expecting the letters from the banks, and whenever we get a branch, the first thing comes to our mind is what is the level of advances. 2 reasons for that. The first reason is well known, because they decide the fees of our bank branch audit exercise. Number 2, what the kind of work we have to do. Because my experience is, we spend more than 50% to 80% time in advances. Out of this 80% time, almost 50% time is on verification of advances, 50% is spent on NPA. And remaining everything, we try to finish in whatever is remaining time. Sometimes this goes up to 90% as well. So I did one exercise, and I spoke to some of my friends and asked them how much time you devote to advances. They gave me the answer which was more than 90%. The requirement of verification of advances consumes so much of my time during this 8 days or 4 days, whatever are available. I felt that we should have some innovative techniques we should use apart from the traditional techniques which we are using for completing our work in time. When we receive an appointment letter, we accept that letter and accept so many things which a bank wants us to do, and one of the things is adhering to the timelines. So naturally, when we as an auditor accept the timeline, we have to fit everything within that timeline. Because we have to understand that the moment the branches are signed, the gap between the date of signing of a branch and date of signing of a bank is much lesser. So naturally, the central auditors will get much lesser time to review what you have done. So we have to plan the things in advance. So what I try to do is, the presentation which I am carrying here, I am keeping it on this machine, request to the branch that they can send it to the mail IDs of all of you who are attending today. I take up once, we attend such program, I go back to office and take a team, carve out members and decide much ahead of time about who is going to do what. If you listen to the first session today, you would understand the importance of how planning would give you a good insight about doing things. So unless you plan it well, you can't execute it well. And in advances, it's really impossible if you plan it, if you do not plan it in advance. Because there are basic types of advances which are always prevalent in all the branches, like cash credit, overdraft, working capital demand loans, term loans, bills, exports, imports, and non-fund based limits. But apart from this, what has happened over a period of time is, I get a sense that whenever I look at one particular advance file, I get a sense that there is something missing out of the working capital which has been funded out of this. Especially the non-fund based limits. When I started my practice 20 years back, I used to tell my team members as well as my seniors used to tell me is that you can spend hardly 10% of tax since the money, the cash outflow is not there, comfortable. Most of the products in the 90s were 100% backed by the security. That was another plus point for the bankers, that the risk was minimal. Today, if you go to a branch, a mid-sized branch or a corporate branch, you would find that the composition of my advances is almost equal, or sometimes it's much more in non-fund based category. And some of the non-fund based categories are so certain to be converted into a payment or a certain liability because bank guarantees issued by Indian banks are discounted in foreign countries the next day or sometimes the same day. LCs discounted the same day in India as well. So somebody has already taken money against it. So on a due date, if the borrower doesn't make the payment good, my bank has to make the payment. So what has happened is, over a period of time, my focus area, which was concentrated more on fund-based limit, is now almost equally divided amongst my non-fund-based limits as well. And in non-fund-based limits, after the 2005 RBI circular on trade credit, there have been innovative products which have come into the Indian market, mostly influenced by the Western products, such as buyer's credit through letter of comfort, deferred payment guarantees, standby LCs, and so on and so forth. You name the product which is available in maybe Singapore or Hong Kong, you can have it in India too. Traditionally speaking, we never used to have foreign currency loans in the balance sheets of Indian branches. Over a period, that is also another phenomenon. Like those which are global banks, like Bank of Baroda or Bank of India or State Bank or PNB, those who have a good foreign exposure. Their clients particularly in Indian branches were in rupee balances, no doubt, but a foreign currency term loans. So the advanced, understanding of various types of credit facilities has become a must. And it's not only a must for all of us who sign the balance sheets or the reports, but it is must for our team members as well. Because biggest drawback when I look at advances is, hardly any one of us would have an opportunity to send the same team which did the audit of the same bank in the previous year. They have tremendous attrition rate. I always call them lucky people. Those who have the same team members who did the branch audit for them last year are doing the same in this year. And mind well, this is a very specialized area which needs a lot of training. So what we are going to go through is, basically I divide the presentation in two types. First one, I would take you through the life cycle of advances, where I am going to deliberate on certain types of checklists which I have brought here, and how one should follow those checklists, starting from credit appraisal till disbursements, and then maybe a flair of each type of loan, like a CC or a term loan or a bill or a buyer's credit for that matter, and giving you some idea or some inputs about how we can plan it in advance so that when we go there actually for the testing, we can cover all the areas. Coming to sample selection, it's again a most important area, but somehow it's not properly documented by most of us. We are just giving a schedule here. This is not something which is mandatory. It's just to give you a fair idea that how you can select the sample. Like say for example in a CC account, a 25% to 40% rate you can select based on your own experience of testing, appraisal, sanctions, disbursements. You can maybe probably select a bigger or a larger sample, or maybe extrapolate those issues to the entire sample and report it at appropriate dates. Similarly, overdraft, term loans, import, export, PG. Now this is a simple idea. Again, this has come out of experience. Now each individual sitting here in the audience has a different experience. So naturally, if you are a continuing auditor of a particular bank, you can change your sample based on the previous year's findings. For advances about 2 crores sanction limit, or 5% of my total advances at the branch. So that could be the base sample you can start with. Further, there are various branches which are nowadays specialized branches. Like say for example a large corporate branch. Large corporate branch which I got an opportunity to sign up 2 years back had some 50,000 crores of exposure. Only 140 accounts. All big ticket size advances, 500 crores plus. So naturally there, even a 10% sample gave me a good understanding about how it works. Similarly, we had an opportunity to do audit of a bank branch which was a specialized retail asset branch, or a specialized housing loan branch, or a specialized vehicle loan branch. So you know the type of loan and the numbers, and then based on that you can select a sample. Now this is again very indicative, very basic, based on your own experience, based on the size of the branch which you are going to audit, you can select a sample which to your best judgment works well. Audit areas, broadly we can define 2 sections. One is a pre-sanction, one is a post-sanction. Most of the auditors believe that pre-sanction we have no role to play. I agree with them. I also agree that we don't have role in post-sanction as well. Because the statutory audit typically, friends, is a post-mortem kind of an activity where everything has happened. At least 10 years back we used to get an appointment letter somewhere in February. So if it is a nearby local branch, we could have probably visited prior to 31st March to just get a hand of it, how it works, what are the things to be done. Nowadays, we get letters only after 25th of March maybe. And then 3rd April, we get returns. Based on those returns, the branch management has to compile so many things. And almost it goes simultaneously. And we have to sign off on 8th or 10th or whatever date the bank expects us to sign off. Sometimes it happens so that the certificates are sent to our offices subsequently post our reaching back to our office saying that sir, ye ek bhi reh gaya. So running the race with the time in that what to do in pre-sanction, what to do in post-sanction. For me everything is safe. But let's see what are the basics at least we can look at. What I've done is I've broadly distributed this into the 4 sections each. Pre-sanction we can take care with applications, the appraisals, the documentation and the external reports, the basic factors based on which the decision of granting a credit is taken. And in post-sanction, what I've done is, I've looked at disbursement, looked at review, looked at monitoring and looked at supervision. Typically, we also form part of this particular activity of review, monitoring, supervision because it's post-sanction, post-disbursement. So let's see quickly how we can do this exercise. What I try to do in my office, once my sample is selected, I issue a statement to the management at the branch asking for a printout of the loan book as on a particular date. If it is prior to 31st March, I take it again on 31st March. If it is post 31st March, that is the first day when you visit the branch, you can take the 31st March loan book. When I say loan book, it is nothing but a simple printout of all ledger accounts which are live. Generally, all the software which I have tested today generates this report. That report is my basis to select a sample as well. Based on that report, I pick up cases for testing, and what I am going to share with you from this this slide number 7 onwards are my simple checklist for testing each type of loan account. But again, these are not configured to each type of loan. These are configured with the life cycle of that loan, starting with application and appraisal, then documentation till disbursement. What we do is, we pick up say 20% cases, say 10 accounts. Then these are the checklists which we print in Excel. Write the heading of the name of the borrower, the sanction limits, date of sanction, and my team member has to tick on all these boxes. Like prescribed application form and KYC, whether it's present. They have to put a tick. So KYC, especially what happens is, KYC is an ignored portion with respect to advances by even concurrent auditors to a greater extent. Two reasons for that. Number one, the concurrent audit report format generally do not include KYC in advances portion. They include it in deposit section. Number two, most of the concurrent auditors, they also face the same problem what we face in bank statutory audit, is that we don't have the continuity of the team. So make sure that whatever selection you do for the testing, make sure that the KYC is compliant. We have heard about the importance of PMLA in the first session. It came in 2002, 2005, the rules came in 2006 onwards. The KYC Master Circular of RBI is no more only a KYC circular, but it is KYC and anti-money laundering circular. And KYC is, much comfortable. AML is most uncomfortable. So make sure that your KYC and AML compliance for at least the accounts which you have tested is verified. Then project report, financial statement. I don't expect my team members to verify the entire bunch of 300 pages, a spiral document. No. Expectation is only the basic things. Like in project report, we all know that there are 2 or 3 things which are key to take a decision. Number one is the balance sheet and profit and loss account and the cash flow. The basis of the future cash flows, a credit is granted. Number two, the FPDF calculation, the maximum permissible bank finance. Number three, the debt service coverage ratio, or other ratios which are useful for bank to take a decision. My expectation is, in the sanction note or the appraisal, they are being properly picked up. Sometimes it happens so that my actual financials show X as my sales turnover, and the projection is 200 times of that. It is possible. Nothing is impossible. Yes, sir.
Fourth item is about the collateral security.
Pardon me?
Collateral security to be provided by the borrower.
Yes.
That will be the fourth item that is to be taken care of.
In which?
In assessing any loan property.
We'll come to that. We'll discuss about security separately. Now the challenge is, out of this, majority of the cases, I have observed that the project reports are prepared in such fashion that the ratio benchmarks are achieved at the first, and then the sales turnover figures are achieved. It's quite evident by just even a simple glance through the figures. Our objection should be in the process of appraisal and not actually questioning those increased figures or incremental projections. I've invariably found that the management doesn't talk about such variation in great depth. Like if I have an increase of 10 times, there should be some documentary evidence for having an orders to that effect in our hands. If they are not there, there has to be some basis on which the management has asserted that yes, there is a possibility of this much cash flow. Beyond that, I think in SAT audit, it will be very difficult for us to test this thing. Then, short review, technical review. Typically speaking, this is a year-end phenomena in a statutory audit. For a concurrent auditor, this is a year-end affair. They do it after we finish our work. We don't really get much concurrent audit statements. Now, this short review and technical review. RBI has a very clear circular which says about how a review mechanism should be established in a bank. So what I have done is, I made a small checklist for all review cases. So what we do is, we select a separate sample for all reviewed accounts. What is the expectation says that check the application from the borrower. Most of the cases which we come across in statutory audit, there is no application as such on place. Sometimes it's so photo done by the bank, either on the paper or sometimes only in the system as well. Just to tweak the date of the future repayment or the first installment due, and that becomes a review. Or they just tweak with the review date. Usually the CPS shows the next review date. They modify it to another quarter. But what RBI says, there has to be an application. That application is to be backed with some financial information, maybe limited, but a justification or a ground why a full proposal cannot be considered. It happens so, a natural calamity. You all remember, last year Chennai had floods. So due to the floods, there were a lot of cases which were deferred for 6 months. So naturally in those cases, the application would be packed by a simple reason that due to flood, my systems are shattered, so I can't give you the full proposal. So there has to be a reason. Sometimes a factory catches fire and a loss is so significant that the management is running after the insurance company to the claim. There has to be a reason, and that should be an acceptable reason to the bank. Then there has to be a credit appraisal. Whatever limited information is received. Friends, always remember, in a review cannot be done for a new account or a fresh account. It has to be an existing account. So the basic contents of my review would be the account statement and account transaction. And based on those account transactions, the debit submissions, credit submissions, interest servicing, proper repayment of the term loan installments, all those factor in my credit appraisal more than the future projections for the next year. So make sure that this appraisal talks about at least some basic things about this. Then sanction could be up to 90 days, that's the normal practice, but the RBI circular says less than 12 months. So technically, if they want to fit into the RBI circular, they can go up to 6 months as well, 9 months as well. There are banks which have a practice of reviewing an account for 6 months as well. That's perfectly alright. Then, what is our job? If this process is not followed, you have to just make a mention that we have verified these many review accounts where 1, 2, 3, 4, 5 was not followed. Job is done. Ad hoc limits, temporary limits. Okay? The basic precondition is that I should have a loan account and then I can come for an ad hoc. Generally more than my existing limits, some additional points. Similar to the review mechanism, RBI has a circular which talks about what banks should take care while looking at an ad hoc. Almost similar lines. There has to be an application. Application has to be justified with why an ad hoc. Giving a reason. Then proper documents to be submitted, financial as well as non-financial. Again, an appraisal has to be done. The appraising authority must accept that there is a need for this much credit. Then it can be sanctioned again for a period of 90 days. That is general practice. It can go up to a period less than a year or a period up to even my existing limits. And then report if this process is not followed. What I do is I select some sample out of reviews, I select some sample out of ad hocs and use this checklist to check whether as per the RBI requirements it is followed. Practically what I get out of it is, most of these cases of ad hoc can be very well factored in at the time of original sanction. Like the reasons which are given are out of my experience, like agriculturists, they get during the cultivation season, at the time of cutting, they get an ad hoc. Or garments, umbrella, contingency, they typically get it during the seasons, festivals. But in India, we all know what are the seasons, right? It's a topic of country, so we all know there are 3 types of seasons. Monsoon comes every time in the December. It comes generally between June to September. So the challenge is, if everybody knows that these are my seasons, and these are going to be my festivals, like 1st January is always a new year, 25th is always a Christmas, 25th December. Diwali, bad luck, we know October, November we get Diwali. So all the festivities which are majorly contributing to this ad hoc loans are known in advance. So as a student it always poses a question to me, then what is the need of ad hoc in case of all these things? I agree that in case of an exceptional contingency, there could be an ad hoc. I'll give an example, like an order is doubled. Like I get an order from X, I'm manufacturing 100 units. All of a sudden, I get it for 1000 units. So naturally, that steep increase in my demand has asked me to come for an ad hoc for a period up to my regular renewal. But take example of even a grocer shop next door, When we look at Diwali time, we see a lot of things in that shop which are otherwise not available in that particular shop. They are only for that season, Like some of them sell crackers. Otherwise they don't sell crackers. So naturally, they take more stock, they need more funds, which we understand. But at the same time, when I ask this question to the branch as an auditor, the manager immediately replies, "Sir, isko last year bhi diya tha, usne time se repay kar diya." Right? That is a comfort zone, for the management. That we had given an ad hoc last year, it was repaid in time. The moment I get this answer, my view is stronger. That this can be factored in at the time of full renewal. Friends, I have seen a lot of changes happening into the sanctioning processes. And I have seen cases where in the next time full renewal, this kind of an ad hoc for a temporary period is already factored in original sanction. So sanction says that 20 crores limit for a full period. However, a seasonal demand need based on an application from the borrower of 10 crores additional sanction. My objection is only to one fact. This review, technical review or whatever you call it, and the ad hoc. They are done in very limited fashion. So that assessment of the credit appraisal procedure is very shorter compared to the full review of the proposal. So if that is done in the full proposal, it will be done in a better fashion. But again, this is my personal view as a student, not as an auditor. If it is an as per auditor, please go on filling in this checklist. If it is compliant with it, go ahead. Yes. Nowadays everything is in system, sir. Earlier we used to maintain in I can tell you, sir, in Finacle or in FlexCube or in Pax24, as on a reporting date, you can generate a report of all add-ons. Because all add-ons are to be separately mentioned as in my account master separate limit. So you can generate. You can ask them to generate. But I think it's difficult to get reports. See, this is only the audit where, sometimes we don't get even access to the account books. But we don't write anywhere, right? We do a lot of things in good faith. My suggestion would be, please forget good faith when you do such kind of assignment. The responsibility is tremendous. If you have not received an access, if you have not received any information, it's better to write that in the front of the report that I have not received it, rather than falling in line with good faith saying that aisa to hota hi hai. No, please don't do that. I just overheard, I was on and off on phone in the first session. The speaker was talking about AFI. Thanks to CBS system, AFI reaches up to a smallest branch also. Traditionally speaking, the AFI team, Annual Financial Inspection team of RBI used to come to large branches because they cover more number of advances, rather more amount involved rather than numbers. But nowadays, thanks to CBS, they can reach up to a smallest branch even up to 1 lakh rupees outstanding loan balance. Naturally, we can also use the system well. Whenever we don't find such reports, sir, I try different techniques always. Like traditionally, we have been talking about auditing. is vouching, verification, inquiries, observations, structured walkthroughs, all basic techniques. They are wonderful. If you use them, we can really reach out to anything. But you have to be innovative in your techniques because that is possible when you have time. Here you are running out of time most of the time. So what I try to do, the moment I reach to the branch, I make sure that I reach out to the data administrator, the poor guy who does the day opening and day closing activity. Make sure that whenever I get a cup of tea, I go and sit with him, order for 2 teas, give him comfort that I understand his or her concerns. कभी-कभी ये भी बोल देता हूँ कि आप ही अकेले हो जो काम करते हो. Make sure that my team member sits at the end of the day procedure what that fellow does. Those who have done visa or CISA would know that unless the branch closes those reports, a day doesn't happen. It's not done centralized. What they do is, there is a process of closure in that lot of reports are generated. All those reports are not mandatorily printed because bank has its own policy how many reports are to be printed. I request that fellow that today please print everything because I need to know what kind of reports are available. It doesn't go beyond 200 pages. But once you get on the day one at the branch and you as a partner or a proprietor review it the next day, you will see the different tone of audit. Because now they cannot say that this report cannot be generated. Otherwise you ask anything, the answer would be, sir, wo system hame nahi pata. Once I get this answer, I immediately tell them, then why are you here then? You should be at home. We are talking about good faith. Please, my request to all would be, the good faith only gives you responsibility and liability, nothing else. The branch manager doesn't even remember you next time. My personal experience is the moment you sign the last statement. I'm not saying that you are going out of the branch as well. The moment you finish that 3,000 page, you are a stranger for them. They don't even recognize you as an auditor. So if you find anything which you feel, be sympathetic to them, no doubt. But write in your report that this is not being done. How to do it is their job, not your job. Your job is to find out whether they have done it according to the law, according to the regulations. If yes, say yes. If not, say no. If you couldn't find out, please disclaim it. But you couldn't verify it, right? I couldn't verify it. There are so many readers, and mind well, everything what you issue is read by somebody. Not at least one level, it could be at least 3 levels. Most of the branch auditors feel that what happened to it next? What happened? I don't even bother about what happened to it. My job is to discharge my responsibility. What happens is somebody else's headache. So please make sure that wherever you can write down everything what you want to write. Because not writing means you are taking responsibility of the things which you are not having any control over. Appraisal, delegation of power, 2 important things. Appraisal talks about somebody recommending something and somebody sanctioning something. So this entire appraisal nowadays is a copy-paste affair. Thanks to computers. Earlier, every time it has to be typed out separately. Recently I came across a case where in appraisal, the condition was mentioned that 120% insurance should be taken for entire stock. Generally, it is done in case of perishable items. Milk, fish. The unit was steel manufacturer. Traditionally, they have been exempted from taking insurance. Now, terms and conditions put up in the appraisal is copied in sanction. Whatever sample you select, 5 accounts, make sure that some knowledgeable guy from your team verifies those and reports. DOP, generally it is available on the intranet of the bank. You can take a print, keep a copy with you. The moment you check the sanction limits, find out based on the sanctioning authority whether they have requisite authority or a delegation of power to sanction that particular loan. Adverse remarks not overruled. Typical cases. A sanctioning authority sanctions something, but when you look at an appraisal, you realize that the appraising authority has recommended something different. Like A is recommended, B is sanctioned. I am not saying whether A and B, whether it's in the interest of the bank, whatever the change is, or it is against the bank, because that is bank's prerogative. But there were A conditions, 1, 2, 3, 4, 5. They have been modified and 6, 7, 8, 9, 10 are being sanctioned. Now the challenge here is, there is a thin line between understanding the power of sanctioning authority. The sanctioning authority has to sanction something within the bank's policy. So if it fits into the bank's policy, the new terms and conditions, the sanction is perfect as per the bank's policy. But as an auditor, our expectation is we should report that the sanction is different than what is recommended. I'll give you a classic example of this. Then we'll come to some, let's see some of the types which have come across over a period of time. Change in directors and partners. A and B are directors, they also hold personal guarantees. And recommendation is that B doesn't have a good net worth, so B should not be a guarantor. But the sanctioning authority takes B also as a guarantor. When somebody has a negative net worth, even if that guarantee is being taken, where from the bank is going to recover. But sanctioning authority has a right or has the power to do it, they can do it. Again, changing security. Classic case I'll give you. There was a case with one South-based bank, where a loan was recommended, sanctioned based out of a big building. Let's say on Ashram Road you have a 20-story building, a prime location, or like port in Mumbai. This was Anna Sarai in Chennai, a business district. The entire building, 11-story building, roughly around 7,000 square feet per floor. 77,000 square feet was mortgaged. Value around 250 crores at that time. Loan was sanctioned, running well, term loan as well as working capital limits, everything was doing well. The borrower approached the bank for changing the security. The change was, they were offering some 3,000 hectares of land near to a proposed international airport. Tamil Nadu has only one international airport, Chennai. They only have one in Old, Chennai. So there was a plan at that time to develop a port which will cater to the business places like Coimbatore, which is an engineering hub, Tirupur, which is a cotton hub. And it was around equidistant from all these three places, well connected to Chennai. So this piece of land, this parcel of land was very close to that airport. And you all know how the prices go up in India. So the valuation, the land was valued little over than the building which was already mortgaged. The recommending officer recommended that this is not a good solution, good proposition, so this should not be accepted. The sanctioning authority had a power to change the security as per the bank's policy. They overruled that suggestion and then they released the building, accepted that land as a security. Again 5 years went by. After 5 years the account became bad. When the account became bad, it became NPA, it became doubtful, beyond recovery, so loss spread. And a whole lot of what happening in last 5 years you all see, you have been witnessing it. Inquiry started. Inquiry came to this particular point. The question came to the auditors that why auditors did not find out this change. Even I was a bit surprised when this kind of a comment came. Because when it's a policy of the bank to perpetuate the sanctioning authority has requisite delegation of power, it has been done. The question was that we look at chartered accountants as professionals who have skepticism, professional skepticism inbuilt into their practices. If you look at AA's 1, now they say 200, the mother of all standards. It talks about professional skepticism. Wherever you find something, you go and revisit your planning and redo things according to the The challenge was the recoverability issue of that security. A prime building in a business district had a better prospect of realization in case of distress rather than that piece of land. I like the logic. But look at how minutely it is being tested. Changing terms and conditions. Nowadays it has become a fashion to change the terms and conditions. RBI has issued a circular which talks about whenever you issue a sanction terms and conditions, it has to be signed by the borrower for acceptance. Now it is mandatory for all term loans, all working capital loans that the borrower has to accept on the face of that sanction letter that I have been called terms and conditions. Most of the time, the borrower acceptance is subject to change in 1, 2, 3, 4, 5. Processing fee. Bank has a thumb rule, 0.5%, 1%. Borrower says will not pay this. I am just giving one example. There could be many. So, I really don't understand. If there is a change required, it can be done at the time of putting up the proposal. If it is not acceptable, it should have been stopped at that point itself. But it doesn't happen so. Now somebody was asking me, what do we do? A condition of acceptance, say there are 25 terms and conditions. Subject to change in 1, 2, 7, so total 3. I am accepting. Does it become an acceptance? To my mind is no. Because technically I am deferring or I am questioning acceptance in only 3. But that may have impact on other conditions as well. I have started writing that wherever I find is subject to 1, 2, 3 under negotiation, I say that they are not accepted by the boss. Until that, nobody has questioned my remark. Because if I say accepted, there is evidence which says that they have not accepted 3. And I really don't have time as an auditor to verify whether all 25, any one of them has an impact because of dropping out of 2 or 3 conditions. The second stage comes here. When the negotiations takes place, there is a change in terms and conditions. Our job is to highlight that there was a change. Beyond that, we don't have any role to play. Because we are not to judge whether it's in the interest of the bank or not in the interest of the bank. That is bank's liability. The one who sanctions loan, disburses loan, it's their responsibility to recover that loan. Not mine. These are some examples. Then adequacy of security. Again, a prime condition. Bank generally has their own policy. Policy talks about what is the percentage of security for a loan. One has to look at whether prime collateral according to the banks is being considered. Exposure limit. RBI has a circular every year, master circular which talks about group exposure. Tax change in policy. All 1st July 2015 circulars are applicable as of now. Changes are being given in master direction subsequently. Around 35 master directions have come in last 2 years. Wherever applicable, please look into it. Then inspection reports. A pre-unit inspection report is part of my uprising. Most of the times, that pre-unit inspection gives a good insight about how to apprise that loan account. But my experience is, when I look at the NPAs, I realize that the inspection was only on paper. So our team should know, by looking at that inspection, by reading at the points which have been answered, whether you get a sense, whether actual visit has taken place or it's only a paper. Beyond that, nothing. Then statutory restrictions, again, section 20 prohibits certain types of advances. Just make sure that your team is aware of it. So if any loan is being given to any of this, check that there are proper approvals required. Like a director of a bank cannot take a loan from the bank unless it is approved. Chief manager and above, scale 4 and above nationalized banks cannot take loan from any other bank unless the head office of that particular employee's bank has given the sanction. Or ozone depleting, like industries such as refrigeration, ACs, aerosol products, they all need to get specific permissions from respective ministries, respective departments, then only loans can be sanctioned. Commission is paid for soliciting loans. not allowed. So just look at these statutory restrictions. Once the appraisal is done, then the sanction terms and conditions are drawn, and that's the point where acceptance is taken place. In 2008, RBI came out with a circular to sign off that sanction letter for a simple reason. There used to be a lot of deficiencies in documentation because of which a lot of court cases are still pending. Supreme Court in 2005 came out with a wonderful judgment. That judgment said that if at all a bank can prove a loan was given on repayment basis by any document, that is a good valid document for recovery. So RBI suggested this, all banks have started implementing that as well. That could be the point you can look into documentation. Other than that, there are standard loan documents, the set which is prescribed as the bank's policy. Most of the time the documents are similar, like hypothecation agreement, equitable mortgage, demand promissory note, guarantee deed, guarantee bond, letter of acknowledgement of debt, so on and so forth. It's a typical list. Check out for each type of loan account what the bank policy prescribes and whether they are accepted according to that. Original documents be kept in safe custody, charge to be recorded in appropriate authority, exercise in case of property, registration of charge with MCA with respect to companies if they are the borrowers, appraisal of information in CBS master, and the most crucial thing. You take a printout of any CBS master for any account, it will be a A3 size 1 page. It would have some dynamic fields, some 80-100 dynamic fields. If at all you take 5 printouts during your bank audit experience, you will come to know that most of the information is not properly filled. But when I say dynamic fields, they are mandatory without putting any input in it, the account cannot be opened. So what they try to do is, wherever there is an alpha requirement, they write A or Z. Wherever there is a numeric required, they write 0 or 9, generally 9. So the information is fed into the computer. Computer doesn't understand whether this is a logical correct input or not. So it generates a print. Look at it. You will come to know most of the times the contact information is wrong. I have seen number of cases where even the name of the borrower is wrong. And when I say name of the borrower is wrong, it can sometimes be grossly wrong as well. So ultimately it's a human intervention. Somebody punches this data. So make sure that you select some sample for master. Give interesting, observations in your LFR. Adequate insurance with bank's clause. Again, what is adequate? The banker always wants whatever is total stock or whatever is total value of asset to be insured. But most of the times I have seen borrowers go for whatever is the limit sanction. So what happens to the difference between the value of asset and the value of loan? This is called salvage value. So in case of fire, whatever is salvage is reduced first and then the claim is passed. So naturally, if at all there is a stock or there is an asset of X value, insurance has to be of X value and not equivalent to my loan account. Banks law, nowadays most of the banks are agents. So they debit it and they take care that the clause is properly put in. But still there are companies which continue with their traditional insurance. So it's our job to verify whether the bank's clause is properly mentioned. External reports. Again, these are nowadays become pillars of credit decision. If you look at the changes happening into credit system in banks, earlier it used to be one individual sanctioning authority. Now most of the banks have a lot of committees. So it's a collective decision. Yesterday somebody talked about NPA. NPA session is today or yesterday it was? So you would have understood how the SMM mechanism would work and how the joint lenders forum would take a call. So big ticket loans, the SDRs would happen with all bankers putting their own committee members. So now even one bank doesn't take a decision, it's all banks put together. I believe that then who is going to be the responsible for that decision? Nobody. That's the correct answer. But auditor would be responsible for everything if they don't comment on it.
In such cases, even the consortium document is prepared for a number of years after sanction.
So it doesn't happen so. The US may be one exceptional case would have happened. Nowadays, documentation is very strict. In consortium, you have an option of having a due diligence report every 6 months. You get to know about the documentation.
If it is done, then Vijay Mallya would not have taken care of it.
Little bit of distraction, but I don't know whether you have read the case very well or not. I can assure you that the documentation is very correct. Documentation doesn't have any role on, charging something to the individual directors or the candidates. Documentation is for one particular plan. That has to be perfect.
But the care was not taken that he was a British citizen. That care was not taken.
Is there any rule which talks about somebody who is not an Indian national cannot take a loan from India? If that is the case, then Vijay Mallya has not taken a loan in his individual name.
There was nowhere mentioned that he is a British citizen.
We need to understand so many things from you. Out of this, I believe that all our external agencies, all are experts in their own fields. Our job is restricted only to find out whether the bank has a particular policy to take a civil report, to take an external rating, to take a valuation. If yes, whether it has been done according to the procedure suggested by bank's policy. But again, for each one of them, I have a lot of reservations. They are the guys based on which their report credit decision is taken place. But I am not an expert as an auditor of any of these fields. I am not an expert to understand how a valuation is done. So I try to give disclaimer in all these files. These are our expert areas. Bank has relied on the experts report. That's what I give a disclaimer. Two reasons for that. Take example of CIBIL. CIBIL is nothing but input data from bankers again. Who verifies that? Nobody knows. How can I rely on the report which is generated out of it? If bank wants to rely on it, they can. My job is to say that bank has relied on it. Beyond that, I can't do anything. Rating. I believe in more internal rating rather than external rating. Internal rating is similar to our mindset. The bankers have been traditionally conservative bankers. We as auditors have been conservative accountants. So our mapping can be easily done. We can relate to our understanding of credit with respect to internal risk rating. External risk rating, I'll give you a small example. I came across a case which was a small foundry. 2 crores was exposure. They were going for upgradation. They were banking with one of the largest banks in India, in one of the largest cities in UP. They were banking with that particular bank for almost 50 years. It was a family business. This was the third generation which was doing it. They were going for some specialized manufacturing. So there was a specific machine which was required for it. So they bought that machine. Total size of exposure was around 10 crores. They had total deposits around 200 crores with the bank. But still bank forced them to take a loan. Or they have taken a loan, let's be on the other side, of 5 crores. You all know, up to 1 crore, there is no rating required. 1 to 5 crores, internal risk rating is workable. 5 crores and above, external risk rating is applied. So external risk rating was done. Rating was excellent, no doubt. I just asked the branch manager casually that why I disclaim it, because I am not so expert to understand it, I can prove it. I asked them to get me an information that what was the process done and how they did achieve this particular rating. They compared the public data. The data which they compared for the particular borrower is available with the banker as well. So with that data, they compared with one international company, one Indian company. They compared with Tata Steel. I remember 91, I was in college at that time. They came up with Indica manufacturing plant in Pune. At that time, the line of credit they were offered by SBI was around 12,000 crores. So look at the kind of size of investment it would have. This was a foundry of 2 crore loan. Is it comparable? One international company that took for those missiles, Pasco. Compared to the return of assets of these giants, their return of assets were exceptionally high. They are few 1000% better than them. Naturally, they got the best rating available at that time. I told them that the moment we will get enough data for SME sector, this comparison is useful. I cannot compare orange with apple, right? Anyways. So I better talk about accepting what bank has done. Yes. Anything you wanted to add? Somebody asked something. Valuation. A pretty simple thing. You all know how the valuation is done? A valuer comes, takes an appointment letter, visits, verifies the assets based on his own experience, her own experience, based on certain, tests and checks which they carried out as per their requirements. Come to us. Do they have any standards like what we have? No. Do you ever have heard of an institute which produces valuers? By and large, they are engineers, I agree. So nowadays, 20% of my probationary officers are only commerce graduates, rest are all engineers mostly. 9% are veterinary doctors. Interesting data, you can find it on IBP's website. Less than 20% with commerce background are POs in last 10 years. Now imagine, I'll give you a smallest example because of the paucity of time, otherwise I'm going to eat out on the next speaker's time. Advantage is I can eat out on your lunch time, that is for sure. Gold valuation. Have you ever seen physically how it is being done? I've seen many times. There are 2 or 3 types or 4 types of methods of doing gold valuation. There is one Superman who just looks at it and says, "ये 22 कैरेट है, इतना रेट कर दो." एक second level का Superman, little less power. You bring one पत्थर, stone, magic stone, कसौटी. घिसेगा थोड़ा सा. There are some sparks. I never see those sparks. He sees even some colors into it, and he says, "ये 22 कैरेट है, इतना रेट लगा दो." Then somebody comes with a chemical. क्या कलर बदलता है पता नहीं, but वो बोलता है 22 कैरेट है. Somebody comes with bit sophisticated caritometer है या ऐसा कुछ है, वो करके. All of them come to a conclusion कि ये gold है. You know how much they penetrate? Less than 2 millimeters. That was 1 or 2 portions of that particular gold ornament or gold biscuit. By just testing that, I mean, we do testing that's acceptable, because we do it out of the universe. We select a sample. Look at the kind of gold frauds which are listed on RBI website. Common frauds, bangles having inside some other raw material. This is very bulky inside. Again, for a common layman, it's very difficult to understand the nuances of how the gold looks like. Those who have seen 1 kg of gold, I mean, I'm in Gujarat, I know most of you would have seen it. In Surat, I normally say everybody would have seen it. I mean, the weight volume ratio is such that, our mobile phone size would be 1 kg. Unless you hold it in your hand, you will not realize it's 1 kg. Your hand will go like this. And that's when you realize that it's 1 kg. RBI has come out wonderfully on that. What they have said? Bombay Bullion Association, average 30-day rate for 22 carat, fix it. Nothing beyond that. Now at least one side is being plugged. So rate, I cannot give variation in the rate. It has to be uniform. But again, quality, I cannot. These are all external confirmation. Whatever our standards suggest, just try to take that benefit. Go ahead. This is the most crucial in today's time. I was reading a newspaper in the morning, taking a clue from somebody who talked about Mr. Malya. Mr. Malya's counsel yesterday talked about 7 lakh crores NPA and why I should be targeted. It's in the news today. I'm not worried about the second part. I'm worried about the first part. That 7 lakh crores. If anyone asks me what is your view, Niranjan, why an account becomes NPA, I would say 2 reasons. The first reason is poor or faulty credit appraisal. Number 2, poor or faulty end use of funds management. This disbursement is a crucial link between understanding the health of the account. What one should do? Look at the master, whether updated properly. Once the account goes bad, when we try to search out in the system, there is no details available. At least 5 accounts. Take a print report somewhere that the master is not properly updated. the master, you will come to know that there would be many reports which would be logically generated if the master is regularly updated. Then disbursement is done as per the terms of sanction. Most of the cases is done direct. What happens is, once I give a credit to the saving account or the current account of the borrower, I lose control on where it is being used actually. As a bank, the best practice would be to give direct payments. See, if I take a housing loan from a bank would put a condition that my check or RTGS would go to the developer with whom I have done the agreement. I'll give you a classic case on this. It's available on the website of RBI, you can look into lost data. There was a small article in a small local newspaper, a city lesser than, smaller than an A-class city, that a particular branch of a particular bank had financed 20 tractors. And there was a small photograph. The name of the company was a big giant in tractors. Their marketing team searched this, they picked this advertisement, called up the headquarters of that bank, asking for this particular branch information. They got this information, their team reached that particular branch. They said that we are from so and so company. We got this particular news item into our radar. If you could have called us, we could have done a better deal because your bank is also part of our contract. So we could have done a better deal. He says, yeah, we have done it the same way. So they went ahead and asked about who was the dealer, which are the farmers, what are their size, what are the requirements, do we have a service center here, do we need to provide you anything, all those kind of marketing things. They got hold of one invoice. They immediately scanned it and they realized that there is no such dealer in the entire network. Small thing. But this was a big impact for that particular branch. It came at the end that there were no such tractors purchased actually. The question came on disbursement. All disbursement were done either in the current account, saving account, or in the account which is opened in that particular agency's name. Well, it's simple, Like if I say in Mumbai and I am an auditor, it will be difficult for me to find out, who are the dealers or who are the agents for various types of vehicles. But in a small town, it's quite obvious that a branch should know it. What happened was, it was just to reach the targets. You all know bankers have to reach 16% in case of agri and all those priority sectors. Nobody bothers about it unless it comes out to the light like this. So end use, not only giving credit, verify whether it's going to the correct account is also equally important. So bankers cannot say that yes, it was paid as per this request. No. Another option, there are typically we have seen loans against the NSCs or postal saving certificates. The practice invariably what we see is the branch management sends the borrower only to the post office. A very bad practice. It should be directly sent, Because I always ask them that if somebody can print the certificates, they can prepare the stamps as well, And it happens invariably. It comes to the light only after the 6th year. So they are demand loans, but nobody pays on demand. It's paid only on the maturity. So on maturity, when that receipt is sent to that particular post office, at that time the post office says that we don't own this. This is not our receipt. And then everybody comes to know that this has happened. And in 6 years, you don't know where the borrower has vanished. So disbursement, end use of funds, spend out of whatever time you allocate, spend your own time on understanding the process. Don't leave me to your team members. That's all. Pretty simple. These are typical checklists. You can pick up any one of them. Like what's actual renewal as per the bank's policy, you may select 2 accounts. You may select 2 accounts for each type, Like for stock inspection and unit visits, you may select 2 stock audit reports and verify it. You can select TP calculation for 2 accounts maybe. You can select a sample. Again, in each type of the typical observations you have. So list down those observations and give it to your team members. That if this is a particular case, how you should report it. I'll give you an example. DP, the maximum issue that we come across in drawing form. How a DP is to be calculated? Can anybody quickly answer? Absolutely wrong. What is provided by the bank in their policy? Why I am saying this? We know one method of doing DP calculation. What he spoke about. That is not the fine. By our experience, we have realized that what he said is the general practice in banks. But don't fall in line with that always. What is suggested by bank in the sanction letter or what is suggested by bank in its own policy? That's it. Don't apply your mind on it. Because credit is bank's decision making. We have a lot of issues because we fix in our mind that this is the only way we can calculate. Why creditors are not removed? I mean, that's bank's decision making. You can, whatever you can write is, you can write in the observation that this is the bank's policy. However, we feel that creditors should be removed. Okay, acceptable. I have recently come across, day before yesterday there was a query raised. I saw the DP calculation. They are not considering creditors. What they are doing is they are considering creditors which are given in the CMA data. I mean, that's bank's policy. But we keep it in our mind that creditors has to go. Again, some of the auditors feel that, if creditors are more than say debtors plus stock, they make it nil, they make it negative as well. Always make sure wherever it's to be removed from stock, not debtors. Debtors also include profit element, so margin on debtors is separate. Generally 50%. On stock, generally 25%. So stock minus creditors minus margin is number 8. Debtors minus ineligible debtors minus margin B. A plus B is drawing forward. Again, most of the banks specified in their policy, so follow what banks say. Right? Then turnover. Again, account statement verification. Most of the CC accounts, when we verify and test it for NPAs, we certainly look for interest servicing and term loan. So similarly, you can pick up certain accounts for operations to cover the processing fee, the interest, the rate of interest, maybe or random sample. Some specific observations in maybe CC, term loans and other areas. Like CC typically fixed limit to look at FDPA. So whenever you select the test sample of CC, just look at the calculation. The calculation generally goes with the turnover limit. So what we know is 20% of my turnover could be the maximum limit. But again, to achieve that maximum turnover, maximum permissible limit, I achieve the maximum turnover. So understand that. Look at monitoring. Again, here as a student I have a doubt. Just if you get time, have a look at it. In CMA data, when my calculation is done for NPPF on net asset method, I work out current assets minus current liabilities, then work out net working capital, then margin, that is the permissible limit. There I consider entire block of current asset, entire block of current liability. So by and large, the basis on which I take a credit decision in a bank is based on my entire balance sheet, entire financials. But when I monitor it only on creditors, stock and debtors. So imagine there is a gap in it. And the entire fight of bank's borrower with the banker is to, bridge this gap between the sanction basis and the actual monitoring basis. And invariably that is the area where auditors target, because we understand the finances well. So just have a then generally reviewed in a year. Servicing of interest is to be observed. Periodical inspection is a must. I have seen many cases the periodical inspection report is signed when you ask for it. It's very easy to identify. Because you will find the xeroxes and only month and amount is written by pen. Rest all information is done for one, then 12 printouts are taken. It's very easy to identify. Please make sure that they take responsibility and you take a backup for that they have done. Rest all story, couple of things to share. I was verifying on CC account and I found that the rate of interest at that time it was PLR based, now it's a different mechanism. However, the amount has to be worked out in some percentage. It was coming to some 12.75%. So what I do, I do some interest verification in case of certain samples. I found that in the particular CC account, the interest was coming roughly around 5% instead of 15.75 or 12.75%. What we do, we don't do the closing balance of the month. What we do is, we do average opening balance and closing balance for the year and then try to see whether approximately the interest is worked out. If not done, we do it for 4 quarters. Opening and closing of a quarter, divide by 2 and then whatever those 4 averages come, we work out that divide by 4, that comes a logical answer. फिर भी वो नहीं match हो. Then we selected 3 months to be tested fully. We realized that on 5th of the month, the rate of interest was reduced by 5%. And on 25th of the month, the rate was brought to the actual level. So what was happening was, on any reporting day, 30th of the month or the 31st of the month or the quarter end, the report of loan book used to display correct rate of interest. But in between, there was a concession offered to the borrower. This was happening for 11 years. You have to make a full provision for that. Account became bad because of that. So all of a sudden 10 years interest you debit. So some accounts you can select for account operation along with some testing of incomes as well. Because loans give maximum income to the bank. Term loans, typically 2 things. End use is monitored by direct disbursements, number 1. Number 2, restructuring. Now what we have seen in restructuring in NPS is different than what I am suggesting. I did one small exercise recently. We tested the retail portfolio of a brand with respect to 4 things. Number 1, account number. Number 2, date of sanction, that is original sanction. Number 3, the sanction amount. And number 4, closing balance as on date. Only 4 things. And we filtered it in Excel, identified wherever the closing balance of today was more than the sanction limit. Once we got this, we filtered it further. We removed all loans sanctioned during the year for which we were auditors, that is 15-16. So what we filtered was sanction date beyond 31st March 2015. So for the year there may be moratorium, there may be issues, so we gave that. What we realized was the entire filtering of loan sanction at least 1 year prior, having more balance than the sanction, we got 40% cases where not a single rupee was given. Accounts were maintained at standard. Outstanding balance was more than the sanction limit, still it was maintained at standard, because in the CBS master, every year the due date of first installment was changed to the next year. Like it was due on 1st September 2014, they made it 1st September 15, 1st September 16, 1st September 17. So naturally the data is altered. When the system generates overdue, it will not show it as overdue. Try this exercise. It covers number of accounts, gives you a comfort because you select retail based on that. Try something like that. Then installments. I have seen classic cases where the installment as per sanction letter is X. It is entered into system as X minus or X plus. And when somebody identifies it and you recalculate it based on the original sanction, account would have been already overdue by many number of days. Make sure that all this data which comes with the sanction letter is fed by this branch into the system. Branch decides the rate of interest. I am talking about CPA. What they have to do is, the parameters are set. They have to say plus or minus something. and work out the correct. Make sure that this input data is correct. Bills, 2 or 3 important things. Number one, whenever you test bills, make sure that you ask for a bill report which is trust ID wise. Because earlier traditionally we used to maintain a register for bills and then we used to circle out the payments or the realization. So it was easy for me to have an audit trail to understand which bill is outstanding from which date. So it was easy for me to test overdue. Today what happens is, there is a GL head, and on the GL head, if I am hitting out on all debits and credits, as on particular date, I get a report which is only an outstanding, which doesn't talk about the dates. But if I get it trust ID wise, and which I have tested in Finacle, LexCube and Banks 24, they have this report. So a borrower's bills would be available to you, and then it will be easy for our team members to verify. If you don't get that, then the GL head, either you or some of the senior team members who understand their business, has to circle it up. Then look at simple things. Beyond 30 days, if the bill discounted is remaining outstanding, visualize. Party value limit should be checked. Exchange control. RBI nowadays permits bills beyond 180 days as well on case-to-case basis. So wherever you find a bill beyond 180 days, make sure that there is a specific sanction from RBI. ECGC premium, again very crucial. This ECGC premium is the only security when it comes to export bills. So make sure that the premium is paid and the claim is settled. Sometimes there are deficiencies in ECGC's condition. The communication file has to be looked into, correspondence file, and we should look into. Bank guarantees LC, I mean traditional business, but again the contents of bills, the contents of bank guarantees are now standardized to the, rather are customized to the need of the beneficiary. Traditionally, 10 years back or 15 years back, a bank used to have a standard format of guarantee. And bank used to issue that guarantee format. Nowadays, it goes as per the requirements of the beneficiary. So beneficiary sends you a format, your format is sent to your legal department. So make sure that every time you have got an approval for that guarantee form, especially if it is a foreign LC. Number two, as I said in the beginning, this has become a very crucial area for our testing because there has been a discounting going on in the international market. So make sure that it's properly documented, proper security is available, and on due dates, if they are not demanding it, it is not crystallized, then you reverse it because it attracts capital. Before I end, maybe another 5 minutes, I would like to take you through into this letter of comfort. 2005 Trade Circular opened this window for Indian companies to raise funds overseas. This simple process, and most of you would have had a chance to look into the buyer's credit as well, either as a consultant or as maybe an auditor. And in fact, this has increased substantially over the last 5 years. Again, in a recessionary economy, maybe another 1 year, you may find a bit of a dip into this. But again, if this Make in India, Made in India, stand-up, startup, etc. works well, and the way the government is expecting foreign funds, I think this is another way of financing, cheaper way of financing rather for the borrowers is working. Make sure that there is an application. Make sure that there is enough documentation done. Because this is a loan raised overseas based on a guarantee issued by an Indian bank. Only through a SWIFT message, so documentation is only a SWIFT message. This is an internationally acceptable document. Make sure that there is a right to recourse for the recovery in India. So there is legal demand promissory note or any guarantees or whatever are being taken from the borrower. Make sure that the documentation is fulfilled. It's approved by the legal team. Make sure that in the treatment, the money is coming. You all know the transaction well. How many of you don't know buyer's credit? How many of you know? For both there are no answers. See friends, buyer's credit is a funding raised for either a capital goods or raw materials from an overseas banker. That overseas banker could be an Indian, foreign bank of an Indian bank or a foreign bank as altogether, what happens is on the due date of making the payment, the borrower approaches a foreign bank to raise funds overseas and make the payment to the original equipment manufacturer or a raw material supplier in a foreign country. So what happens is the Indian bank issues a letter of comfort through SWIFT to that lender, saying that on a due date, if this borrower doesn't make the payment good, we will make the payment. Similar to a financial guarantee. Now on that particular day, that lender sanctions the loan, credits the nostril of my Indian bank. Indian bank makes a payment to the beneficiary. So the transaction gets over. So what happens is, in my books earlier if it was an LC, the LC was for the borrower. So accepted is by borrower, the liability is towards the beneficiary. Because the bank guarantee, LC, all non-fund based limits are accounted in the books of the bank, so on both sides. In our Companies Act we show it in footnotes, but here they are accounted in the books. So acceptances and endorsements they call it. So endorsement is to the beneficiary, acceptance is by the borrower. So on the due date of LC, what happens is the LC is closed and a new document of letter of comfort comes in place, where the endorsement earlier was the manufacturer, now it becomes the foreign lender. So the liability is towards that lender now, and the acceptance of earlier borrower was towards the LC transaction is removed, and for this LOF, again the borrower becomes my acceptance, recoverable from the borrower. So make sure that 100% risk weight in capital gain, in capital adequacy is being calculated. For LC, it's a variable rate from 20 to 150% in Basel III. But for letter of comfort, it has to be 100% because it is treated as part of financial guarantee. And then look at the treatment, servicing of interest and repayment of loan. On due date, the bank has to make the payment of interest on the principal. Interest that 115CA and 115CB are the two forms which one has to file. One is to be filed by the assessing, one is by the accountant. In there, you have to certify whether a TDS at appropriate rate has been deducted or not. So make sure that compliance to that is also being done. I think that's what I have. Any questions? If you have, time permit will take it. Otherwise, thank you very much, friends.
On behalf of WIRC of ICAI, I thank you our learned faculty, Niranjan Joshi for giving us in-depth knowledge on the topic of audit of advance.